Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Middle of the week, Wednesday morning, we are coming to you as always from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleague Surabhi and Nigel. Guys, hi, good morning.
Hi, morning, folks.
Morning.
So middle of the week, muddling along. At least that's us. But I think the markets had a fine form. I mean, it's not too bad. I mean, yesterday a bit of a pause for the broader markets, but it's been good going, I guess.
I think par for the course, right? I mean, after the kind of run that we had, par for the course, I guess so. So let's get straight to the action, Prashant.
I mean, Trump is like, I was thinking the right analogy, right? A kid with like, I don't know, a toy gun or something. And, pointing, I'm going to shoot you. I'm not going to shoot you. I'm going to shoot you. I'm not going to shoot you.
That's a good analogy.
It's, I don't know. I mean, it's...
And on that analogy, CNBC did a CFO survey. And I think over 60% of them are saying that they cannot decide what to do with their businesses because there's just too much uncertainty. Yeah,
absolutely. So. And, let's just quickly run you through, what you need to know. And it's Trump, all Trump. And the thing is, we don't know. We just don't know how large, how the extent of the tariffs or anything of that sort. So markets remain on tenterhooks as far as the 2nd of April tariff headlines are concerned. Chasing headlines or... chasing price action ahead of this, into this, I mean, I think just doesn't make any sense. We just don't know, as I said. Now, but what we do know, Trump last night, once again, sort of, he's obviously on the air very, very frequently. He said that 2nd April tariffs are set. I mean, he set them. So they are in there, but he gave no real details. And then this morning, as we were coming in, there was another sort of line which came through. I just want to quickly put that up as well. He said that I'll likely be more lenient than reciprocal, on reciprocal tariffs. So, for example, I'm assuming what he means is, say, X country charges 10% or 20% on US goods. He won't be reciprocal by charging 20%. Perhaps he'll be a little more lenient to the extent of that tariff rate. But, who knows? As I said, lots of comments come back and forth. And one day it sounds more harsh. The next day it sounds a little more lenient, etc., etc. Anyway, the price action. Nasdaq was up about 0.46%. Was up for the third straight day. 10-year yields, nothing very much in macro markets. 4.3 on the 10-year, was down 2 bases. You had dollar index, which stays above the 104 mark. Slightly lower last night. Oil prices above 73, but again, no great change. So, I mean, these markets are steady. Copper, I think, is the talking point this morning, again, because of these tariff-related news bits which are coming in. Prices last night were up 2.5%, and they were on their way to an 8-month high, and I think they've moved up even more this morning. And we'll have Manisha talk to us about commodities, etc. in a bit. In terms of data, and this is, I think, the consequence of the uncertainty that we were talking about earlier, the Conference Board's 6-month expectations have fallen to a 12-year low, while 1 year ahead inflation expectations are at a 2-year high. And this is the, stagflationary kind of situation. Remember, about a year ago, Jerome Powell was asked about stagflation. He said, well, I don't see stag or inflation. But I think now this has entered the mainstream talking point. Now, Philly Fed non-managed, the services index also slumped. That came in the lowest since May of 2020. Just a quick bit on what markets are pricing in. The markets are pricing in a rate cut, fully pricing in a rate cut in July. For the full year, about 62 basis points worth of rate cuts are what is priced in. Reports that Russia and Ukraine have agreed to a ceasefire over Black Sea. And of course, Trump was also on the record saying that, well, he's in deep conversations with both sides to resolve that conflict for good. Just the levels now, and I said this yesterday in the morning as well, maybe a little bit of a pause because of the April 2nd event which is in front of us, and of course the big rally that we've had from the lows. Yesterday the Nifty crossed the February high of 23,807, but we could not close above it. So that becomes the first resistance, 23,807. And then yesterday's high, which was 23,869, are levels to take out. On the downside, the 20 hourly has been pulled higher. That number stands at 23,577, and then the 40 hourly exponential, which is 23,322. For the Nifty Bank, it looks like a little more tricky. The reason I say that is because we crossed the 61.8% retracement, which is 51,883. We did not close above it. But forget closing above it, we actually ended lower on the day. So have we completed something on the Nifty bank from the lows to the highs? The question, we don't know the answers to it yet because we are above these averages. The 20-hourly, 51,322, and the 40-hourly exponential, which is 50,634. So maybe a little quieter. FIIs have been buying loud, but the market price action was a little more quieter. We'll see. 60 points higher on the GIFT Nifty is the indication this morning once again. Surabhi.
Okay, well, Asian markets right now, they were a lot happier in the morning when they opened up, but now as the session progresses, they've kind of cooled off a little bit. They were happy, obviously, because of, the expectations that Mr. Donald Trump may not be very, very disruptive come the 2nd of April. So that's what you've got. You still got some green. The mainland Chinese market has dipped into negative, but otherwise most of the regional markets, Japan, Singapore, Hong Kong, all of them are still very much up and about. On currencies, just a word over here. Over the last couple of days, the yen has gone back to its weak ways. In fact, even this morning, the dollar yen, as you can see, is trading above 150. So the recovery on the dollar that we've seen last couple of days, today included, the dollar index is still very much above 104. That's meant some weakness coming back to the yen and to an extent to the euro as well, but more on the yen. Anyway, just to talk about oil, because for India, that's one issue. The fact that quietly Brent has now inched up from 69. Remember, it was sub 70 just a couple of weeks back. It's back up to 73 plus. And that's because of the fact that the oil market is still very worried about Venezuela. Those are the prices on our screen. As you can see, almost 73.30 right now. There was good news on that Russia-Ukraine deal, which the US has successfully managed to broker, at least a partial deal on the Black Sea. So what they've said is that they'll allow a safe passage for navigation for ships around the Black Sea, and they won't attack each other's energy infrastructure. So this has been done, this partial ceasefire. But the market, like I said, is still worried about how many Venezuelan barrels go off the market. Iran has fresh sanctions, so how many additional Iran barrels are not coming to the market? So that's keeping a bit of an upward bid on the price. To talk about our market here, 7 winning days for the Nifty. It's been a fantastic streak, though, of course, yesterday the broader market took a bit of a pause. And that's after 6 days of a rise on the mid-cap index. By the way, the cash market volumes yesterday were up 13% above the 10-day average. So there's some more activity that's picking up as obviously the market recovery is gathering steam and momentum. The flows, no complaints here whatsoever. Once again, third day running a solid 4-digit buy figure coming in. Over 4,300 crores of buying from foreign institutional investors explains why the large cap market was doing so well. Domestic institutions were on the sell side again yesterday. Sold off stocks worth about 2,770 crores. Lots of stocks in focus today, and plenty of deal action could be in focus as well. These two companies, now both of them have a board meeting. Whether there's going to be a deal or not, we don't know right now, but these stocks need to be watched. Earlier, M&M's name was in the fray. Now, Ashok Leyland's name is the fray, so let's see if there's a deal brewing over there. NCC's backed a massive order, over 10,000 crores of an order, so that's a stock on the radar. And finally, the Siemens sort of demerger, that's continuing to chug along. It got the NCLT approval yesterday. Energy business will be demerged into Siemens Energy India. So we'll have 2 different listed Siemens entities soon. So plenty of corporate action as well. Global Q is not that bad this morning.
Well, that's right. But what about the FI buying?
Solid.
Seems they are in love again with the Indian markets. 20,000 crores in 4 sessions. And even after these kind of inflows, they're still net sellers in the month of March by close to around 7,000 crores.
Because of the earlier selling that happened.
Let's see whether or not in the next few trading sessions, they could possibly deliver a net buy number for the month of March. That's the hope. Let's see how it goes. Well, but the call was for some consolidation yesterday's trading session, and very rightly so, right? Because some of those technical indicators were indicating that. The PCR had moved to around 1.3 or thereabouts, which was at the higher end of the range, 1.2, 1.25 intraday yesterday as well. The RSI as well, that had moved to around 70, which typically suggests in the near term maybe a bit of an overbought zone. And the India VIX as well had perked up. So these indicators, well, they call for some kind of consolidation. What do the FIs do? They're showing us the big money in the cash market. We like it. What are they doing in the F&O market? Well, they seem to be covering some shots, and that's been the trend. Even in yesterday's trading session, close to 3,000 contracts were covered out. The net short positions continue at around 67% or thereabouts. And this is the power of short covering. Because in a matter of few trading sessions, they have halved their net short contract. Just take a look at that. From around 1.8 lakh contracts to around 90,000 contracts. But the clients, they're the ones that have been getting it right. They have been, buying into this market. They had their long positions that were at very, very aggressive levels. And as we saw the market bounce, well, they've gradually been scaling down their long positions. So in the last few trading sessions, as the FIs cut their shots, well, they have unwound some of their long positions and booking some profits as well, because it's down by close to around 1 lakh contracts, from around 1.39 lakh contracts to around 38,000 contracts or thereabouts. Well, moving to the options data, it's going to be important because tomorrow we'll have the monthly expiry that will play out as well. 24,000 call, 23,800 call gives you an indication that the bears want to go ahead and defend the 24,000 odd mark. And that's pat in line with where the 200 DMA is at. So that's going to be the important resistance mark. The recent high that we have seen, 23,870, and the 200 DMA. Crucial resistance zone. Only once we get past this, you'll be banking on that we see a further breakout from here on. In terms of support level, going by the options data, going by where you have the DMA as well is at, you'll say that around that 23,450 becomes the important mark. Yesterday's high becomes important on the Nifty Bank. We did a bit of a U-turn, so that becomes the near-term resistance. And you have the 200 DMA, which is a support zone as of now for the Nifty, the first level of support. As we speak, the Nifty Bank yesterday closed somewhere in the middle of this range. But the IT index, was it a flash in the pan, or are we good for more? Because in yesterday's trading session, we had made this point yesterday that the Nifty IT index could possibly try to pull back some of that underperformance. And that's what happened yesterday, because the index was the outperformer, and it's ended closer around the 20 DMA. So I'll be interested to see whether or not it's good for more. Stocks that I'm looking at, well, there's buzz of a deal, because yesterday, towards the end of the trading session, we had Ashok Leyland that had put out this notice they're going to be having a board meet and they're going to be having an investor call as well. And, various sources from Money Control indicate that maybe there could be a deal in the offing. So we'll have to see how that goes, whether there's a deal, whether there's something with regard to the group that they want to do. Ashok Leyland will be the stock that we'll be tracking in. And since the report indicates, SML Isuzu is the other one that we'll be tracking.
Okay, all right. So lots to track and lots of individual company and stock level action as well. Let's get started then with the equity call of the morning. Rahul Jain of Goldman Sachs says that while their strategy team also believes that the worst is likely behind us in terms of economic growth and earnings trajectory, and prices have corrected meaningfully, they see higher market volatility in the near term, given still elevated domestic positioning in small and mid caps and ongoing global uncertainty from tariffs. Consequently, he adds that they remain market weight on India within an EM context and recommend focusing on quality growth and earnings visibility. He says the top 10 ideas that offer 23% upside on an average include HDFC Bank, AU Small Finance, M&M, Make My Trip, Interglobe Aviation, Adani Ports, Power Grid, Apollo Hospitals, Titan, and GCPL. Lots of interesting names across a range of sectors there.
All right, Taimur Beg is now with us, Managing Director and Chief Economist at DBS Group Research. Taimur, good to have you with us here. Thanks very much. It's been a while. Prashant here. Taimur, hectic and absolutely frenetic pace of news flow and headlines. Much more, I guess, than the first time around. But now we're at close to 2nd of April. What is your own sense, Taimur? From a market perspective, I guess, directionally, is it going to be, as strong as what we've heard? Many in the administration say it's going to be harsh. It's going to be more lenient, as we've heard from the president himself last night in an interview. What's your sense?
I cannot accept the lenient part of the promise. I think that's very unlikely, given that Donald Trump fundamentally believes in the power of tariff as a tool to raise revenues, bring manufacturing back to the U.S., as a negotiating tool. So if he thinks of tariff as the most beautiful word in the dictionary, for him to sort of be lenient on that seems sort of counter to his character. I think the stick of tariff will be on our head for the rest of the term of Trump. It's not an April 2 event. It's not what happens 1 month after that. It'll just be back and forth, back and forth. So if the market is sort of, reacting favorably towards some terms that he is sort of using right now, I think it is bound for disappointment.
Although, Taimur, in the case of Canada and Mexico, we've seen, these tariffs, etc., and the announcements being walked back twice over. Many have been watered down. Many have been completely walked back. So, yeah, absolutely, he believes in tariffs. But if the example of these two countries is anything to go by, I mean, there will be room for negotiation.
There'll be room for negotiation, but I think the biggest casualty of the last 9 weeks is the loss of reliability. I cannot really rely on a U.S. promise that something that they're promising today will stay like that. I mean, if 2 months from now, Trump wakes up on the wrong side of the bed and he changes his mind, there is zero check and balance associated with that. That is the biggest problem. So yes, we can look at some data points of the last month or so and say that, it hasn't been that bad for Mexico and Canada so far. The auto lobby in the US seems to be particularly persuasive in making Trump not be that draconian, because that would decimate the US manufacturers more than anybody else. But at the same time, that track record, in my view, is not a marker for reliability, because the back and forth on both directions makes it impossible to say that if something is going to have traction. And by the way, this is not only with respect to tariff. I think it's with respect to foreign policy, national security, global trade and commerce, everything. That how can any partner of the US, ally or adversary, rely on the US, given that its proclivity toward vacillating is at an all-time high right now?
Okay, I mean, absolutely. And that's exactly what's been captured in the CNBC CFO survey. I was alluding to that earlier as well, Taimur. Just reading off some of the highlights. 90% CFOs say tariffs will cause inflation. And there are a whole host of other worries in terms of how to sort of align your supply chains. So, Taimur, given what you said, now we may get that number on April 2, and then maybe it goes into negotiations. Maybe it's not exactly market disruptive, financial market disruptive, but could it continue to be economy disruptive? So therefore, if we talk about, say, the Fed itself, I mean, the US economy itself, are you in the camp that believes a recession is possible? What about the responses then from the Fed? And then, it just complicates the situation for other global central banks as well, doesn't it?
Absolutely. I think that the underlying momentum in the US economy is on the softer side, but it is not flashing recessionary signals to me. There is exceptionally high level of uncertainty about policy, about the international environment, about the dollar. But I don't think we're talking about an outright stagflationary scenario where growth goes to negative while inflation goes to 3. I think if growth goes to negative, it'll pull down prices independent of what is happening on the tariff end, because it'll be a massive source of demand destruction. Now, there's some technical plays that we need to consider. The first quarter GDP number for the US is likely to be weak, but that is an artifact of the fact that a lot of imports have been, to use an Indian term, preponed. They have been brought forward, and they have been, they're going to contribute toward a large negative contribution of net exports to GDP for the first quarter. But when you look at retail sales, they're weak, but not exceptionally weak. When you look at payrolls, they're not exactly surprising on the upside anymore, but they're still very robust. When you look at wages, they're still growing in real terms. So I don't think we're on the cusp of a recession-like environment, but that huge uncertainty is a marker for likelihood of postponing investments. That's bad for the medium-term growth outlook. It is also a marker for maybe some large-scale consumption that get postponed. Having said that, if you look at home sales numbers of the last 2 months, it's not that bad. Interest rates have come down a bit. There are certain parts of the U.S., Washington, D.C. would be one example, where there is significant amount of paralysis in the market given the Doge-related firing. But for vast swaths of the U.S. economy, the fact that mortgage rates have come down a bit has had a positive impact on refinancing as well as on outright housing purchase decisions. So I'm not in the recession camp. I do think that Trump has added a great deal of uncertainty to the outlook. I do think there are some inflationary implications near and medium term that we have to deal with, as tariffs, in my view, are inevitable. But that does not put me in the recession camp. That puts me in a slight, mild, soft stagflation camp or something like that.
Okay, all right. Hi, Taimur. Good to hear that, in fact, that recession fears not really come to the fore as of now. So that's good news. Let's keep the US market aside and the US economy. Let's talk about India. I recall the last time we chatted, you were hinting that in the first quarter of this calendar year, we could possibly see the rupee stabilize in that 85.5 to around 86 odd band. Good on you, because there were most of the calls were suggesting 90 odd. And we've seen some kind of consolidation, a pullback. Where do you see the rupee headed? That's point number one. How do you see India's growth pan out from here on? Because there are signs of recovery as per the last sprint. What are you working with for the next year?
Right. So let's take the second question first, and then I'll talk about the rupee. So in terms of the growth outlook for 2025, we're sort of cautiously optimistic. There is some degree of caution, especially with respect to informal and rural sector demand. But we do think that some degree of revival in animal spirits in the equity market, some additional news on capital formation, some good news coming from the fiscal side with respect to revenue collection point toward no further downside to the growth outlook. But we are cognizant of lingering weakness in the informal and rural part of the economy. So 6.5-ish is where we are going going to peg our growth forecast for 2025 and beyond. As far as the rupee is concerned, there is an interesting phenomenon going on right now. The countries that are very keen on dealing with the U.S., accepting whatever demand that they can anticipate coming from the U.S., are likely to see an appreciation of this currency vis-a-vis the U.S. dollar, because the U.S. also would demand that U.S. dollar weakens against their currency. If you have read some of the outlines of the rather dense Mar-a-Lago related discussions, that seems to be one of those policy objectives of the U.S. that try to revive competitiveness of the U.S. economy by weakening the dollar, and that means that their partner countries would have to appreciate their currency. So if the market sort of accepts that the Indian authorities are also amenable to allowing the rupee to appreciate, will not tolerate depreciation. So I think the risk reward toward the rupee remains on the appreciation side, especially since India seems so keen on dealing with Trump and already taking preemptive measures to ensure that some of the really bad stuff from the trade war do not come to the shores of India.
Taimur, just 30 seconds, 30-second response to this. They've said they want the dollar lower for competitiveness, and the dollar has been falling. Do you think that continues to be the case? You said tariffs will be with us for the full 4 years. But do you think a broader dollar will also be a feature for the full 4 years?
I don't think so, because I think that there are some major internal inconsistencies in the Trump model, and that will come to fore. So you cannot have, the tariff and weak dollar simultaneously. Part of the negotiation is to force dollar down, but I don't think strong dollar and strong tariff are the things that should go together. I think that's the way it should go together, not the other way around. So if there is major risk-off in the world around recessionary concerns, among major disruption to global trade and commerce, and we have a lot of policy uncertainty lingering from the U.S., I think the dollar smile remains, independent of the very recent phenomenon. I don't think Trump will get everything he wants, because there are some major flaws in his economic model.
All right, stronger dollar, higher tariffs, stronger dollar, and that's the inconsistency that you've been talking about. We'll see. Thank you very much for joining us, Taimur. Good conversation, and good to get that perspective from you. Appreciate it. Well, I'll just quickly run you through what's lined up here over the next 2.5 hours. 8:35, you'll hear from Ajay Singhani of EPAC Durables, joining us to talk about the approval for disbursement of the second tranche of incentives under the PLI scheme. So that conversation coming up. We'll have Abhishek Kumar of JM Financial Institutional Securities. IT, 2 days now. The index is up almost about 3.5%. 9:20, we'll connect with the team at ICICI Prudential AMC. We'll have the three heads in terms of the equity and the debt side. The management of EIL makes an appearance at 9:45. You're seeing them after a while, and we'll talk to them about business, how things are looking. So Vartika Shukla will be with us, and towards the end of the show, it's the economy, Latha, in conversation with Niti Aayog agricultural expert Ramesh Chand and Harish Damodaran on the Indian Express article on how Trump's tariffs can hurt Indian farmers.
Well, time to slip into a quick break, but we've got a lot of stock-specific action to track for you on the other side. We'll get to that in just a bit in our special Top 10 segment, but I'm running you through the list for now. Ashok Leyland, SML Isuzu, NCC, Siemens, Federal Bank, lenders of Jaiprakash Associates, Zaggle Prepaid, Stylum Industries, SIS, and Exide Industries. All of them will be reacting to positive news flow. Slip into the break, come back, get into further detail on all of these names.
Welcome back. Like we've been saying, most of the Asian markets are in green, slightly off the highs, but largely the color is still positive, so no problems there. Let's pull up the GIFT Nifty and the implied open. The indication is that we'll also start higher, maybe about 50-odd points on the Nifty. I will just get that up for you in a bit. There are, of course, lots of stocks, individual stocks to track as well. So let's straight away get to it with our CNBC-TV18 list of top stocks to watch, and we have our entire team standing by to run us through the names. Sudarshan is opening up the order with a focus on Ashok Leyland and SML Isuzu. Everyone's talking about this potential deal, Sudarshan.
Good morning, Surbhi. So first up, why these two companies will be in focus? Because Ashok Leyland yesterday late night has announced, basically has called the board meeting, and that is scheduled for today. And companies saying that it's called at a very short notice to inform about corporate updates. Also, post the board meeting, company will be holding conference call and the analyst meet at 5:15 p.m. Now, this is what Ashok Leyland has informed. But what we understand from the sources, and that Money Control has reported that Ashok Leyland is one of the contenders to acquire SML Isuzu. Last week, we had also reported of M&M was one of the contenders. Now, through Money Control, we are understanding that Ashok Leyland is also in that list to acquire SML Isuzu. And if that acquisition happens, so currently promoter shareholding, if you look at SML Isuzu, majority of the share, one is the major promoter, that is the Sumitomo Group, which holds around 44% stake as of December 2024. And if you talk about Isuzu, it's part of the public shareholders. It's one of the largest public shareholders with holding of 15% stake. And one of the other largest public shareholders is Sachin Bansal, who holds more than 19% stake. So what we know from Money Control, that Ashok Leyland might acquire the stake of Sumitomo and Isuzu, and if that is, look at the valuation, that is valued at around 1,400 crore.
Okay, all right. We'll wait and watch to see what comes out of that meeting. Thanks a lot, sir, for that. Well, let's hop across to Vivek. He's here to tell us about NCC. They're raking in the big order wins. Hey, Vivek, good morning.
That's right. Good morning. Close to March end, and the whole host of slew of order wins are being seen across a lot of capital goods as well as infrastructure names. So NCC yesterday announced that it had secured 2 work orders from BSNL. This for design, supply, installation, as well as operational and maintenance services for middle mile network as far as BharatNet is concerned. They have received orders, and these orders are spread across 2 separate states. The first order is from Uttarakhand. The value of the order is 2,640 crore. The other order is from Madhya Pradesh. The value is over 8,450 crore. The order size as well as the order booking will be split into 2 separate components, CAPEX as well as OPEX. CAPEX portion EPC amounts to a little over 5,700 crore, while the OPEX portion is valued at a little over 5,000 crore. The network construction is expected to be completed within 3 years, and this particular contract also allows for 10 years of operational as well as maintenance services. With this, NCC has now achieved the order inflow guidance that it had given at the start of the year of 20 to 22,000 crore. Watch out for NCC today. Expect some green in the stock.
All right. Thanks very much for that. That's a big one for Nagarjuna Construction. Vivek, thank you very much for that. Now, Siemens is the next one we want to focus on. Hormuz is here to tell us why. Hormuz, morning.
Morning, Prashant. And there's a big approval coming in for Siemens, the NCLT approval for the demerger of the company and its energy business as well. Now, the demerger has been effective from last night, and the shareholders of Siemens will get 1 share of the demerged entity, which is Siemens Energy India, for every 1 share that they held as of the record date, which has been fixed as the 7th of April. Siemens Energy India will also be a separate listed entity now on the bourses, and according to the company, that will lead to unlocking of shareholder value as well. And Guilherme Vieira de Mendonca has been appointed as the MD and CEO of the demerged entity, while Harish Shekhar has been appointed as the executive director and the CFO. So finally, the approval coming in for NCLT, a positive development coming in for Siemens.
Okay, all right. That's Siemens. Hormuz, morning. You're also watching out for Federal Bank. What's happening there?
Morning, Surabhi. Some developments from Federal Bank on the M&A front as well. They've increased their stake in the insurance JV, which is Aegis Federal Life, by 4%. Now they currently hold 30% in this JV, where the other 70% is held by Aegis. And the total consideration for this is around 97.5 crore rupees, and they are valuing Aegis Federal Life at around 2,500 crores based on this transaction. And of course, is subject to approval from the RBI and the insurance regulator as well, likely to be completed by the end of October. Another positive development for Federal Bank as well.
Okay, all right. Thanks a lot for that, Hormuz. So, well, let's hop across to Ritu. She is here to give us an update on the Jayaprakash Associates insolvency case. Ritu?
The deadline to submit expressions of interest for Jayaprakash Associates ended last night, and we've been given to understand that as per the last count, as many as 26 suitors have come forward, and that includes prominent names like Adani Group, JSPL, Vedanta, Wellspun, as well as Oak Tree Capital and Arcil. The COC is now expected to meet to take these on record before the due diligence starts and final bids are invited. Now, keep in mind, JP is facing claims of more than 57,000 crores under IBC, but banks have already transferred their loan exposure to NARCL for about 12,000 crores under the 1585 structure and already received 15%, that is 1,800 crores in cash, while the rest of the recovery is going to remain contingent on the outcome of this IBC process.
All right, Jayaprakash, an asset which has been up in the air in terms of what will happen to it for the last, at least, almost 10 years now. Thanks very much, Ritu, for that. Zaggle is the other one which is in focus. Rima is here. They've completed an acquisition. Rima, tell us more.
Indeed. So Zaggle has completed an acquisition of about 38% stake in mobile wear tech. For a total amount of about 22 crore rupees. But this was announced earlier. We had chatted with the management. They'd spoken about how they're acquiring the first tranche 26% stake for about 15 crore in September of 2024. Now it appears the company has completed it, and this acquisition will help the company strengthen its payment offerings. By the way, Zaggle has been under a lot of pressure. Even yesterday, the stock closed with a cut of close to about 5%. And what we understand is that the 1.5-year lock-in, which freed up 20% of the equity, outstanding equity of the company, ended yesterday. So that's been putting pressure on, Zaggle. And the stock on a year-to-date basis is already down about 33%. And its 52-week high was 591. So the stock is still very far away from those levels. Back to you.
Okay, all right. Thanks a lot for that, Rima. Well, let's hop across to Mangalam. He's here to tell us about Stylem, some protection coming in for them. Mangalam, morning.
Well, it's the season of duties, anti-dumping duties and tariffs, etc. because now there has been an anti-dumping duty imposed by the government on acrylic solid surface imports from China for the next 5 years. Remember, Stylem Industries was the one that had filed for this anti-dumping duty on acrylic solid surfaces. And of all the acrylic solid surfaces supplied in India, 70 to 80% comes in from Stylem Industries itself. So this imposition of anti-dumping duty, especially for the next 5 years from China, should be a positive for them. See some green on Stylem today.
Got it. So we've added that to our list as well. Mangalam, thank you for that. Back to Sudarshan then to round up a bunch of other stocks that are also in the news today. Sud?
So I have two stocks. First one is SIS. Board has approved share buyback of ₹150 crore at a price of 404 per share, which is at a premium of 18% if you take yesterday's closing price, and the buyback would be done via tender route. Second up is Exide Industries. Government has made certain amendments to the rules, and because of that, lithium-ion battery will be now part of core auto components. That can be positive for battery players like Exide Industries and Amar Raja.
Okay, all right, got that. Sudarshan, thanks very much for that. Let's quickly recap our list of stocks to watch. The ones that have positive news flow around them include Ashok Leyland, SML Isuzu, NCC Siemens, Federal Bank, the lenders of JP Associates, Zaggle Prepaid, Stylem, SIS and Exide Industries. There are actually no stocks that have negative news flow around them. So it's an all-green list once again. With that, let's now head across to the commodity world. We have Manisha joining in with a roundup of all the action. Manisha, good morning. It's not gold, it's copper that's hitting bigger headlines overnight, isn't it?
Oh, it absolutely is. Even as gold is at its sidelines, copper clearly taking a lead in the metal as a sector. So we've seen all-time highs in the U.S. markets, not the LME, which the markets really follow. But the COMEX copper is at an all-time high, above $5.22 a pound. Prices have gained almost 3% overnight. Well, there's been this news that U.S. President may impose tariffs on copper imports as well. So buyers in U.S. are stockpiling ahead of these potential tariffs, and that has led to a very huge premium in the U.S. markets vis-a-vis the rest of the world. So copper prices in U.S. are expensive by 13 to 15% right now versus the rest of the world. Also, there was another news suggesting that Glencore is temporarily halted copper shipments from Chile due to some furnace issues. So this new supply disruption news also added to the markets, and we've seen prices run up. But it's not just about copper. Silver gained 2.5% overnight. Gold was up 1%. Brent crude is trading at a 3-week high, and that has led to gains in rubber, which is trading at a 2-week high as well. So, well, it's a very strong start to Asian markets when it comes to commodities, but definitely copper taking all the lead.
All right, Manisha, thank you very much for that. So that's commodities and copper, more specifically, very much front and center there. We'll take a quick commercial break here. Gurmeet Chadda, managing partner and CIO at Complete Circle, will be with us for some fundamental stock conversation. Stay tuned.
Welcome back. Well, we have Gurmeet Chadha joining in this morning to take a couple of questions. He's, of course, from Complete Circle. Gurmeet, great to have you on. Good morning to you. So much happening with this market, right? But we're talking to you now in happier times. I mean, a week and a half in sentiment is so different today, right? I want to start with the auto space first because there's a lot of chatter about a potential deal. SML Isuzu seems to be the target, and we don't know if it's Ashok Leyland or M&M. But your thoughts on any of these stocks, one, two, or all three of them? Just very quick takes.
So we have M&M as one of our top 10 holdings in the portfolio. So to give you the disclaimer, I think it's done very well for last 3 years or so. Great capital allocation strategy, cutting down on loss-making JVs, and I think even in this quarter till Feb, while March numbers are yet to be out, they are beating the industry both on SUVs as well as tractors and farm equipments. Valuations have become more reasonable post the 20-odd% correction, some price and some time correction for a quarter. Isuzu, not sure whether who gets it, but seems to be an incremental addition to both of them since they are very dominant in the bus portfolio and the commercial side. It could probably be a better fitment for Ashok Leyland. Their SUV portfolio of Isuzu is something which hasn't really taken off. And if you see their PAT figure also, it's about 2,000 crore market cap. They're doing around 100 crore PAT. So valuation-wise, assuming that it happens at current market cap, 5% here and there, valuation seems reasonable. But as I said, the fitment could probably be more for Ashok Leyland. But we need to see how it plays out. We are very constructive on M&M. It's firing on all three cylinders. One thing you have to watch out for is 2nd April in terms of the tractors and their export units to US, but that's also relatively compared to other OEMs, it's quite marginal at the front. So we are pretty optimistic as far as M&M.
The market cap is about 2,300 crores, and the buzz was, at least what some of our colleagues were picking up, is that M&M wanted to do the deal at about 1,800 crores market cap. So maybe we don't know how it goes. Quick take on Ashok Leyland. Stock has been in the dumps for now years. Could this be the jumpstart it needs?
We need to see the proper revival in commercial sales. So that those numbers have been pretty soft. It was available at 60 bucks if I remember in COVID. So from that period, probably almost 3.5, 4x. It hasn't done bad, but it's doing better than Tata Motors on the CV portfolio. Their EV platform also has been a little soft, including some of the launches in that segment. So you need proper triggers in terms of numbers coming through, big revival coming through. I think government capex has picked up December onward. So my sense is this quarter might be a little better. But we don't own this particular stock in our portfolio.
Just to close, Gurmeet, hi, morning. Just to close the loop on autos, I remember, I think you had a few ideas a couple of weeks ago. Names like Precision Camshaft was one. Mukund was another. Any thoughts? These are the two I remember. Any thoughts? I mean, have you been buying these? Still constructive?
So, Prashant, Precision Camshaft, we actually trimmed a lot of our exposure in December, considering the slowdown we saw in Europe and overall commentary coming in from major OEMs. We've been adding to Uno Minda in the portfolio. That's a more content per play for us. And they've been really expanding their bouquet in terms of the offerings. It has recovered a little bit. Almost came in 4 digits, then again has seen a bit of a correction. But auto in general has seen that. We have Sandhar Technologies in the portfolio. The casting business continues to do well. Locks, they already have almost 40-50% market share. Valuations have become reasonable. They have been reducing debt, in the portfolio. And we have a bit of a quasi-auto play, KPIT, which we've been holding for now almost a little over 4 years. But that again, probably in the near quarter could be a little subdued, considering that it's only dependent on case, and auto overall has seen some bit of softening, but KPIT has been massively investing in R&D and technology. So for us, it is a more long-term play.
Okay, all right, Gurmeet, request you to stay with us. Going to come back to you and ask you about, the other parts of business, like what do you like from the EMS space? For the time being, let's hop across to EPAC Durable. They are on our radar. The company has received approval for disbursement of the second incentive of 30 crores under the PLI scheme for white goods. Discuss about this development and how is the business momentum shaping up. We're joined by Mr. Jay Singhania, the MD and CEO at the company. Hi, Mr. Singhania. Good morning, and thanks a lot for joining in here on CNBC TV18. Give us a few details about this incentive that you've received. For which unit was it? Which component was it? And what's the outlook from here on?
So good morning. The PLI incentive we received was actually for the last year, the financial year 2024. We received it just yesterday. So the disbursement has also come. And it's a 5-year window during which every year we are going to get the PLI incentive subject to our achievement of the target set by the government. So again, this year we are on track to achieve another 37.5 crores, which for this current financial year ending March. So in terms of the market outlook, I mean, the air condition, our main product, definitely the summer is hitting up every month on month, and the inventories in the trade are still at bare minimum. So I mean, we are in for a bumper season, definitely.
Okay, all right. Just to ask you a little bit more on that, what is the total PLI you've received for FY25 and for FY26? What is the total quantum?
Yeah, so FY24 we received 30 crores. So this was accrued last year, has been received yesterday. And then again, this year, we are going to accrue 37.5 crores, which should be received. Yeah.
Got it. All right. Let's get to a couple of numbers then. Since
just if I could come in over there, on the PLI, which specific component or segment is it for? And do you have hopes of more receivables even in FY26? This year, FY25, you said 37. FY26, are you expecting anything? And which are the components or segments for which you're receiving this PLI?
So this is for the AC and LED TV PLI. So in AC, we are manufacturing all components except the raw materials. So we're doing all the components like cross-flow fans, motors, heat exchangers, sheet metal and everything. So for which 30 crores has been received. This is a 5-year window. So this was the second tranche of the receivable. Now current year FY24-25 will be the third, and then there's another 2 years, so 26 and 27.
Okay, all right. And as you mentioned in your first answer itself, that demand seems to be strong as summer's picking up. Not too good news for us because it's getting so hot too early, but maybe good for your business. What does it mean in terms of business? I think earlier you were guiding for margins of around 7.5%. What's the broad outlook for FY26? Since you're in a bit of a silent period, we'll let you go on FY25. But on the base of what you deliver in FY25, what kind of growth can you give, as well as what kind of margin outlook?
Last year, the market grew at almost 40%. This year, again, the AC industry is looking at a growth of 25% plus. So definitely at EPEC, we are looking at surpassing the market growth for AC. And then the other diversified products, which we have started creating, like the washing machines, the air fryers, and the component business all put together, we are definitely looking at 35% plus kind of growth for EPEC Durable for FY26. And we will maintain the metal margin at 7.5% plus minus.
Are you being conservative with that 35% number?
It's just the beginning of the year. So, I mean, we first let's go through Q1, and then there's always time to upside the numbers.
And since you're talking about the sweltering summer, Mr. Singhania, we were in conversation with Blue Star and some other industry players earlier, and there was this lot of chatter about possible compressor shortage. I don't know if you're already making all your compressors or if you're also importing, and then there's been obviously a request with the government as well to reduce certain non-tariff barriers. I think it was BIS certification, I'm not sure, which could have led to this shortage. Can you tell us what's the situation and how do you meet your compressor requirements?
So see, compressors specifically more than 50%, almost currently 60% of the compressors are imported from China. And as a country, we only have capability to meet 35-40% of the domestic demand. So we are heavily dependent on China, and for which the BIS for a lot of factories is going to get expired in June, whereas for 2 factories, it already got expired in November. So the industry as is facing a problem of compressor shortage. And then further down, when more factories the certification expires in June, and the situation is going to get worse. So this is why the industry has been pleading that the BIS certification for this industry, compression manufacturer is good tech.
Is it going to hamper your production? I mean, has it affected production at all in Q4? Could it affect production in Q1?
Q4 definitely as an industry, and besides us also have been slightly impacted, but industry has been impacted more. We were comparatively better covered, I believe. And then for Q1 also, we are definitely covered. So we have enough inventory in place. I mean, our orders are in place and we're definitely covered with the secured orders. But yes, as an industry, we are facing this problem.
All right. Thank you very much, Mr. Singhania. We'll talk more, but good to get that update from you this morning. Appreciate it. So that's EPAC Durables with some update. 343 is where that stock is at. Gurmeet is still with us. Gurmeet, any thoughts? You heard the EPAC management, but also, of course, consumer durables is a pack. And EMS, etc., which kind of ties in with this consumer durable theme. By the way, yesterday we had two players. We had the Retailers Association of India for a chat, and we had the Electronics Mart, which is concentrated in Hyderabad, Telangana, Andhra, and of course NCR, etc. as well now. And both kind of said demand in January to March, which is the quarter we are in, which is the quarter we are finishing, has been extremely subdued. I asked specifically about consumer durables as well. They said, well, it's kind of very muted. Apparels, etc., zero growth, according to them. Any thoughts?
Yeah, in fact, some of our channel checks also suggested that it's not as great as the commentary coming in terms of early summers. So, Prashant, we have Dixon in our portfolio. We've been one of the lucky beneficiaries. So it's not really related to AC per se. But, I think a lot of good news is probably in the price at current prices at around 13,000-14,000. And these guys trade at 3-digit multiples. So any disappointment in any quarter can be very brutal in this kind of market. So may not incrementally add to it, but you should get some more meaningful corrections, because we think this electronic component is a very structural story. And you will keep seeing more and more top line growth of 30-40%. And the minor increase in OPM with the kind of value addition they are doing, especially in mobile segment, can add to the numbers. We are tracking Amber now. So if you see of top 10 RACs, they supply to almost 8. So whether it is Daikin, Voltas, Panasonic, Blue Star, Whirlpool included, they are now working on the mobility segment. So in terms of Indian Railways, etc. And then they are obviously diversifying into other segments. But as I said, there is very little price comfort. And in this market, you want to be anchored at places where there is at least some visibility of earnings and some growth. So I think we are looking at Voltas. We've recently taken some position at around at current price levels and adding Voltas to the portfolio is more reasonably valued. And it is a more mass brand vis-a-vis some of the others. And we probably expect their EMPS division, led by Middle East and others now, to start contributing. It's been a bit of a drag. Although the Voltas Beko JV, I don't think so will add anything meaningful. It will probably continue to be the drag. So that's one idea we are looking at in this space in terms of incremental addition.
All right. Well, Gurmeet, we'll take a quick commercial break here. Stay with us. A lot more questions coming your way with some technical trades as well. Mitesh and Sudarshan join in on the other side. Stay tuned.
Welcome back. You're tuned in to Bazaar Morning Call. Well, let's get you a technical check then. Mitesh Thakkar as well as Sudarshan Sukhani join us on the show. Good morning, gentlemen. Welcome to the show. Sudarshan, you go first. You've got the color, I think, right? Most of us are in pink and purple in the in the studio. But tell us, what's the call on the index? The Nifty is the GIFT Nifty suggesting we gap up 50, 60 points or thereabouts. What would you do? Would you buy into this jump, or are you looking to add on dips, or do you believe you want to stay away for now?
Yeah, good morning. Yesterday, my suggestion was to take profits and step aside because there was a lot of volatility expected. This is not rocket science. When markets have gone up for 2-3 days, then they will pause and probably become volatile and choppy. So yesterday it buzzed out like that. But, this is a very strong up move. In a strong up move, a one-day correction could be exactly what we will get. Maybe this one-day correction came to an end yesterday. Again, I suggest looking to buy. You can buy at this gap up. It doesn't matter. At 50 points, it can go up and come down. So you can't time it so perfectly. Or you can buy at a gap up and add on a minor dip. Primarily use call options for April series because we will have a 3-day weekend. So it's much better to look into the next week rather than today and tomorrow. But be long in the Nifty. And keep an approximate stop at 23,300. And remember that the stop can jump after the protracted weekend, but we can't do that. So I'm repeating, buy call options, go long.
All right, buy calls, go long. It's, as Sudarshan said, a better way to kind of get over the hump in terms of that news flow early next week with those tariff announcements, etc. as well. And it's a longer weekend as well. Monday is a market holiday. Gentlemen, good morning. Mitesh, to you, what's the call? And especially a word on Nifty Bank as well, which crossed that important retracement yesterday, the 61.8 of the entire fall, but then actually ended lower on the day. Have we completed something there, Mitesh, or do you think not yet?
No, Shanti, I think, good morning. One, we have had a good reversal, and once you have a strong reversal, you will see, supply levels of pivots being taken out. It did that, but what it did not do was to get a closing above the gap down level, which happened on the 18th of December. We had a closing of 52,139 on the 18th December, and next day morning, the open was 51,428. So there was this gap, I think just filled the gap. But then some supply comes in, people who are stuck at a gap level typically will tend to sell when their levels come back. So very normal reaction also is the fact that we were overbought on the hourly and 2 hourly chart. So even if there is more decline, as Sudarshan also mentioned, I think every decline now should be a buying opportunity. Even a small gap up is okay to go along with. I think the Bank Nifty, once it clears this 52,000 level, can easily head towards 52,500 and then possibly even 53,100. So quite positive, and the structure is looking biased on the upside. So stay long. There's nothing to worry about. Only thing is that tactically you might want to see if there's a dip playing out to enter at a better level and get a good risk-reward equation. But otherwise, staying on the long side is the way to go forward for the next few days and weeks.
Okay. All right, gentlemen, stay on. We'll come back to you for your stock picks in just a bit. Take a quick break. Back with also the market opening rates. Also, we'll get a conversation going on the IT services side of the market. JM Financial Institutional Equities Abhishek Kumar will weigh in on their IT outlook. Welcome back. We'll start getting the pre-open rates now any second. Let's quickly, in the meantime, go to our experts again and get an idea of the stocks you can work with today. Morning to both of you, Mitesh and Sudarshan. Mitesh, what are the stock ideas for the morning?
Yeah. Good morning, Subi. I have all buy calls last many few days. Today is a buy on Bajaj Finserv with a stop at 1924. Look for targets around and excess of 2,000. Britannia is a buy with a stop at 4,800 for targets of 4,950. A buy on Max Health with a stop at 1155 for targets of 1205, and Reliance is also on the buy list. Keep a stop below 1270. Look for targets of 1310 to about 1315.
Okay, Reliance is doing well in the pre-open, up almost 1%. Got it. Sudarshan, what about your stock ideas?
Well, Bandhan Bank is a buy, and consider buying the stock under 144. ID stocks seem to be coming back. Coforge had a very deep correction, but it's been an outperformer. So Coforge could be considered for buying with a stop under 77.80. Similarly, Tech Mahindra Techem is a buy with a stop under 14.20. And finally, Voltas can be considered for buying again, stop 14.50. This is an all-buy list. This is not a good time to go short anywhere.
It's an all-buy list, not a time to go short. Got it, gentlemen. Thank you very much for the quick updates over there. The pre-open is a little volatile, you'd have to say. The sensex is dipping into negative territory. The Nifty is managing about a 25-30 point sort of a gain. Mid-cap index is absolutely flat. So it's a quiet opening that I think we're approaching. Some of the heavyweights are still doing well. Like I said, Reliance is pretty decent. And a couple of banks, ICICI, Kotak, they are still flashing. Some green for the time being. Ultratech is cooling off quite a bit after yesterday's move, down almost 2%. Okay, I think we have Gurmeet still with us, so let's take some more questions with him. Gurmeet, so the FIIs are finally here. They found India on the map again, it seems, right? So let me ask you this broad question. Anyway, everybody was saying that large cap valuations are better and you should have more large caps in your portfolio. So within the big boy space, give us one pick, a stock that you're really convinced about. And I hope it's beyond a bank. Like, banks has become a very obvious trade now, right?
Yeah, so I think we like Interglobe. I think they're almost adding one aircraft every week starting second half of this year and maybe early next year. I think you will see early double-digit growth in passenger traffic also. They've given a guidance of almost 120 million passengers, a lot of routes getting added, international destinations getting added, and I think the newly launched business class also, I think they'll probably gain some bit of traction there. And some amazing cost efficiency models would be, I mean, 10 minutes saved on 900 kilometers in every flight in turnaround time is additional 700 flights a year. So I think it's probably one of the case studies there. And I'll give you one more. We're adding L&T more. I think you will see a pickup in government spending. And I think what we are seeing now is they're not just an EPC player. They're into energy solutions. I mean, there are already news of Qatar energy contract coming their way. They are building OSOCs, which is, semiconductor assembly and testing units. And they're obviously getting into defense and other solutions. And order book is almost touching 6 lakh crores in first 9-10 months. It's a gigantic order book. So I think that's another one space which looks good from a near-term visibility as well.
Got it. So Interglobe and L&T, two stock ideas coming in from Gurmeet this morning. Thanks very much, Gurmeet. You have a great day, and we look forward to connecting again soon. Thanks for joining in. All right, so this is what we have in the market. Pre-open seems to be sort of settling down. Like I said, fairly quiet, about 30-35 points up on the Nifty. That's what we have at this point in time. We're putting the spotlight now on the IT space. Of course, IT stocks saw decent gains yesterday. UBS has come out with a very bullish note on the sector. Earlier this week, CLSA said that uncertainty is perhaps priced in for most of the Indian IT players. So what is the outlook ahead? Let's get one more view this morning. We have Abhishek Kumar, IT analyst at JM Financial Institutional Securities, joining in. And I think they have a slightly more cautious approach given the uncertainty around US spends. Great to have you, Abhishek. Thanks for joining in. So some of your foreign broker peers, they suddenly sounded optimistic. What's your view?
Yeah, hi. Good morning, and thanks for having me here. You're right. I think we are a little cautious. See, the environment is little uncertain, especially around decision-making when it comes to IT budget. This is the time when clients finalize their calendar year budget, and it has coincided with, a lot of uncertainty coming out of the administration there. So it is very natural for the clients to take a pause. Now, to some extent, I agree that the correction that we saw in the sector priced in some of the maybe earning cuts that can happen because of the delay in budgeting or any potential cut in budgeting. We heard Accenture also not giving a very rosy picture of the environment as we speak. So yeah, keeping those things in mind, I think it is, we wouldn't advise, investors to really go long at this stage. Maybe there is a tactical pullback. We will see how Infosys guides next month. All eyes will be on that. That will set the tone or expectations for growth for 2026.
Abhishek, some numbers here. Some of the brokers, they've actually lowered their overall FY26 growth estimates as well because of the uncertainty in the US. I mean, I think high single-digit expectations came down to mid-single-digit expectations. Overall, if we talk about FY26 earnings, what are your numbers saying?
Yeah, so we haven't lowered our numbers yet. We will do it, when we come out with our preview note. And we have been, interacting with some of the companies and experts. And I think the thing that we are picking up is there are pockets where there are pauses in ramp ups, etc. Even there are some instances of ramp downs. So things are not very clear. And my sense is the initial guidance that Infosys might give could be a little conservative. They would also not like to build in too much discretionary spend coming back, etc. So initial guidance could actually be, mid-single digit or even lower.
All right. Hi, Abhishek. Good to speak to you after a while. FIs, they've returned to the buy basket after a while, right? You would be interacting with a lot of your clients. What's the interest levels for tech particularly? Because everyone wants to see what has not really performed. And top of the list in this year has been tech. The Nifty is flat. The tech index itself is down 13%. What are the interest levels you're getting? What kind of feedback you're getting from institutional investors?
Yeah, so, a lot of people want to understand, if there is a US recession, which companies will be more resilient, right? Because they don't want to underwrite strong growth. And as we just discussed, the growth rates are coming down. And in that scenario, what is the right valuation levels where they can start taking more positions. So it is the resilience, especially among the large caps, where people are more interested. And, in that context, we believe TCS earnings will be far more resilient. The growth expectations are low. The margin improvement story, I think, can pan out. Their, margin, operating performance, etc., is always very strong in the current environment. So I think we would advise people to stick with TCS. Earning resilience is there, and it is the only stock now which is trading at its 10-year average multiple, right? Every other stock is still at a premium to their 10-year average.
Okay. So that would be your top bet as well?
Yes,
TCS
at
is
this
the top
stage,
bet?
among large cap, TCS is a top pick.
And if you could give us the preference, TCS top of the pack, what follows?
Yeah, so we think Tech Mahindra. They're also the earning. So my thesis is that for next year, companies where the earnings is going to come from margin expansion will see more resilience in their earnings, and TCS and Tech Mahindra fall in that bucket. So these two will be, my preferred pick, followed by Infosys.
Okay, all right. Let's give us your closing comments then. What are you going to be watching out for with regard to quarter four's numbers? No big shakes expected, but commentary will be eyed. Tell us the top couple of points that we should be tracking from the majors, because in the next 20 days or so, we'll have almost all of them reporting.
Yeah, clearly. So apart from guidance, obviously that's the quantitative number. In terms of commentary, how the deal wins are shaping up. Has there been any delay in, decision cycles or elongation of decision cycles, especially when it comes to larger deals, or, delay in ramp up of deals already won? And a little bit on margin pressure or pricing pressure. These are some of the things that I'll watch out for to, build our numbers for the next fiscal year.
Good speaking to you as always, Abhishek. Thanks a lot for stopping by. Looking forward to having a chat with you as the earnings start trickling in as well. Wishing you a good day for now. Well, let's get our technical guest back on the show. Sudarshan joins us for the 9:10 call. Sudarshan, what's it?
Well, it's Voltas. Consider buying Voltas with a stop under 1450.
Voltas is getting very, very hot, and on the technicals as well, Sudarshan believes it's good for more. Mitesh, what about you?
Yeah. I'll go with a buy on Bajaj Finserv.
Bajaj Finserv as well as Voltas. Thanks, gentlemen. We'll touch base with you in the next hour or so. For the time being, let's hop across to Hormuz. He's here to tell us about Morgan Stanley as well as Goldman Sachs top bets. Hormuz, take it away.
Morgan Stanley has made some changes to its Asia ex-Japan and the emerging markets focus lists as well, where they have included both Bajaj Finance and Hindustan Aeronautics. For Bajaj Finance, it recently raised its price target to around 10,500 after Rajiv Jain's elevation. And they say that they see a clear investment outlook, and it is now among the preferred picks among the large NBFCs in the country. For HAL as well, they say that the India's aircraft fleet upgrades and expansion plans are likely to create a $60 billion order pipeline over the next decade for the company. Here too, they see an upside of anywhere over 30% for Hindustan Aeronautics. Goldman Sachs has come out with some top buy ideas for its India list as well, where they highlight stocks like HDFC Bank with a price target that is near to 2,100 rupees. AU Small Finance Bank, which has been in the news recently, an 800 rupee target there. Among the consumer names, they have Titan and Godrej Consumer as part of their buy recommendations. Within the industrial names, they have stocks like Interglobe Aviation and Adani Ports, and they also have buy recommendations on stocks like Mahindra & Mahindra, Apollo Hospitals, Power Grid, and on the foreign listed companies, they have a buy recommendation on Ease My Trip, $124 price target there as well. So interesting recommendations coming in from Goldman Sachs as well.
Okay, all right. Thanks a lot, Hormuz, for joining in and giving us that list. But Manglam is joining in to tell us what BofA has to say on Zomato as well as Swiggy. Manglam.
Good morning. So yesterday, we were talking about how if food delivery for all these online aggregators starts to slow down, then there might be a risk of downgrades, largely because there is still uncertainty on the quick commerce part of the pie as well. And that's exactly what has happened. BofA has gone ahead and downgraded Zomato to neutral from a buy. They've cut their target price from 300 to 250 odd rupees as well. And they've downgraded Swiggy as well to underperform from buy. They've cut the target price out there as well from 420 rupees to 325. They said that this downgrade is led largely by expectations of rising losses in quick commerce and slowing food growth. So as a result of which, in their revised estimates, their EBITDA for the companies over the next couple of years is 20 to 50% lower versus consensus itself. They're saying in food delivery, while it's not a material slowdown, there might be cash burn or cash flows will shrink out there. Remember, the food delivery business is the cash cow for all these companies itself. And in quick commerce, estimated prolonged competition and the model itself would be amenable to higher losses, as a result of which they believe it's better to wait for some certainty and look for signs of revival in the online food delivery ordering business for them to go ahead and become constructive on this space again, and as a result of which maybe risks are more on the downside than the upside, hence the downgrade.
Okay, all right, Mangalam, thanks a lot for that. Well, Mitesh is still with us. Mitesh, I wanted to ask you about the tech pack. Yesterday, the index itself went to around the 20 DAB. It's been a relative underperformer. The view on the index, any stocks you like from there?
I think the Nifty IT does look like rebounding from oversold levels, but that bigger change which has happened on the Bank Nifty is missing. So I think it could just at best give you a trading rally. The one which I like the most is Naukri Info Edge. That was one of the strongest in the pack. And I think that's heading towards 7,500 kind of levels. And that apart, I think, from a trading point of view, HCL Tech and TCS also could possibly give you about 4-5% trading gains.
Okay, all right. Thanks a lot for that, Mitesh. We'll come back to you with more queries with regard to stock moves. The tech index, as we said, yesterday did well, but maybe, in fact, it needs to give a bigger sign to break out from here on. Well, we're almost there with regard to the pre-open rates. It's likely to be a flattish to a mildly positive start. So we get a few rates up for you on the screen. On the Nifty, we open up mildly in the green. We're up close to around 30 points or thereabouts. Par for the course, one would say. No single stock is up more than 1% from the Nifty pack or down by more than 1% on the Nifty pack. So pretty much even Stevens. Hero MotoCorp is up 0.5%. JSW Steel, well, that's the one that yesterday became the most valuable steel company by market capitalization across the globe. That one, in fact, is more or less flattish to kickstart trade. Maruti Suzuki, that's down close to around 0.5% or thereabouts. Let's tell you about the broader markets because we have some big movers out there. Some of them come up for you on the screen. NCC, they are back 2 orders worth around 10,800 crore rupees from BSNL. So that's the stock that's up close to around, I think, 4.5% to kickstart trade. So good going on that one. Welspun Enterprises, that's the one that's back close to around a 330 crore order from the BMC. So that one as well, I think it was up close to around 3%. Now it's up close to around 2%. Ashok Leyland, that's going to be the stock in focus all through the day because the Ashok Leyland board meet is scheduled for later today. And post that, they do have an analyst meet as well. So we'll keep an eye out on that one. Siemens, I saw the initial tick was in the green. That's because the NCLT has approved the energy business demerger into Siemens Energy India. Stock holding high with a gain of close to around 2.5%. SIS, a small buyback is what they have announced. They're going to be looking to buy back close to around 2.6% stake, worth around 150 crores or thereabouts at around 404 rupees per share. So that's the stock we're looking at. Stylem, let's get that one up for you on the screen. That's the one that is in focus with the government has imposed anti-dumping duty on acrylic solid surfaces imports from China for a period of close to around 5 years. So that one as well should come up for you on the screen. And Arvind Smart, I think the stock initially was up in the green. They have sold close to around 200 plots. The total value on that one is close to around 180 crores in Bengaluru. The stock yesterday went home with a cut of close to around 4%. Arvind Smart Spaces should be the stock. That's up close to around 2%. So a flattish to a higher start is what we're seeing on the Nifty. From the Nifty pack itself, actually, a few stocks are doing well. Power Grid, that's up close to around 2%. Bajaj Finserv, that's the call that we had coming in from Mitesh as well. He's quite positive on that one. That's opened up at the green with a gain of close to 100%. And we have IndusInd Bank that's opened up in the green. Remember, on valuation front, there is a lot of support out there. The question is, what else are we expecting in terms of a negative surprise? Otherwise, valuation-wise, even taken into account that write-off, well, the stock trades at around 0.7 times or thereabouts. But Vivek joins us now to help us out with the JP Morgan note on the power companies. Vivek.
Well, that's right. Good morning. The utility space has been in focus. This is on account of, the rising demand that is expected due to the impending summer season. Today, it is the turn of JP Morgan. They've written a note where they've initiated coverage on utility space and within the utility sector. They have coverage on 5 stocks. Within those 5 stocks, NTPC and Power Grid, the regulated utilities, is where they have an overweight rating. NTPC, they have a target price of 417, Power Grid a target price of 316. Tata Power, they have a neutral stance, JSW Energy underweight, and Torrent Power is where they have a neutral stance. What is the key point as far as that they're making as far as the utility space is concerned? They're saying Indian electric utilities as well as independent power producers actually face structural power demand growth. However, they say that there are sectors in which it makes sense to go ahead and chase expensive stocks. However, they believe that the power or the utility space is not one space where you can go ahead and chase expensive stocks. However, when it comes to individual stocks, NTPC, they have an overweight rating. Remember, they believe at 1.6 times price to book, it's quite reasonable for a regulated utility which is capable of generating approximately 12% return on equity on the book value. Now, coming to Power Grid, they are quite positive on this particular name. They call it their preferred play on structural growth in India's transmission capex story. On Tata Power, they believe that while there are significant positives, the stock, which is currently trading at 2.9 times FY26 price to book value, for average ROEs of 12% at this point of time, risk reward is not very favorable. On JSW Energy, they believe that the valuations are actually at this point of time capped upside, which is why they have an underweight rating over there. And lastly, Torrent Power, once again, valuations at 13 times FY27 EB to EBITDA is what is limiting the upside. Overall, a positive note as far as the power demand is concerned. However, valuations is where they, at this point of time, they have a few underweight and neutral rating on stocks.
Okay, all right. Thanks a lot for that, Vivek. Well, let's cut across to Prashant as well as Surbhi for our very special Market Master segment. Guys, take it away.
Hello and welcome to a special edition of Market Masters. Is the worst over for markets? That remains the big question. Trump tariffs are the clear and present danger for global markets, while India middle-class tax cuts and potential RBI rate cuts are the two tailwinds which we can see right in front of us.
Absolutely. Today we have the top team at ICICI Prudential Mutual Fund joining us to discuss a whole range of issues, and they have assets under management of around 9 lakh crore rupees. ICICI Pru MF is the second largest mutual fund in India. Equity assets at close to 6 lakh crore rupees and debt AUM at around 2.5 lakh crore rupees. The AMC's equity PMS and AIF assets stand at around 33,000 crore rupees. So, Prashant, we're talking about some very large numbers and big money managers here.
And a big view then as well, right?
Yes.
I mean, and a rounded view, because we've got the equity managers, we've got the debt top leader as well. Let's welcome in Anish Tawakle, CIO, co-CIO equity. Anand Shah is CIO PMS and AIF, and Manish Banthia is CIO fixed income at ICICI Prudential Asset Management Company. Gentlemen, thank you very much, all of you, for being here on this special edition of Market Masters. And I think it's an important and interesting time to get that view from you, because so many people who write into us, who reach out, and the feedback from social media and otherwise seems to all point to this one question. Is the max pain over for markets? The maximum pain over? Is it behind? And while we may not be in a extremely bullish phase, are we to take that maybe, the worst is behind? Anish, let's start with you.
So if we look at the equity space, right, our view is that the large cap space is fairly valued, but one still needs to be cautious in the small and mid cap space. So that's the overall view. What is that based on? We expect the economy to regain momentum. Right. Our view is that there is no fundamental problem in the economy. There is no structural imbalance that needs to be addressed. Inflation is fine, current account deficit is fine, inflation expectations are reasonable, bank balance sheets are healthy, corporate balance sheets are healthy. So the only thing that's ailing the economy is weak demand. And weak demand is a relatively easily solvable problem if you get fiscal and monetary support. We do expect monetary support to be forthcoming. And if that were to happen, then we do expect the economy to regain momentum. So in that context, the multiples in the large cap space are reasonable, and if one invests for a sort of a 3-year horizon, returns should be reasonable. At the same time, we would say, look, some of the very exorbitant return expectations need to be moderated, right? So people were, over the last 3 years, had got used to very high returns, and that phase might also not be coming, as you were saying.
That's good to hear that you seem quite confident, Anish, on the underlying trajectory of the economy, and you say there's no problem. Let me quickly get in Anand's view on this as well. Anand, so that's the house call. Now, what is the approach that you're taking? And tell us a bit about what you've been doing through the phase of the correction as well. Have you been churning the portfolio a lot, or have you chosen to use this dip to add to some of your bets in infra and related areas that you've liked in the past?
Sure. Hi, good morning. So yes, as Anish said, look, the challenge with the market was there was unprecedented, if that's the word I would use. There was an exuberance in the market. You had a very solid 4-year runs in the market, but more importantly, for almost record 27 months, which is around from June 22 to September 24, we didn't have a 10% correction in the market. So I think the challenge with the market was not as much. I mean, yes, there was a challenge in terms of growth relative to what we have seen in the previous 4 years. The earnings growth rate was also very strong, 35% plus for 4 years. That's also sort of tapered down, but fundamentals in that sense were not like really challenged. The challenge was in the marketplace, which is the valuations and all that. So if I see the data, as on end of February, almost 80, while the markets are down 18.5, 18.8 odd percent, 80% of small caps, as I see, were down by more than 30% from their 52-week high. 60% of mid caps were down more than 30% from their 52-week high, and almost 50% of large caps were more than 30% down from their 52-week high. To that extent, that sort of over-exuberance, we believe, has sort of softened, or we've seen a quick reversal in the market. And to that extent, valuations in individual stocks, individual segments of the market have now corrected to make us a little more comfortable going into the markets, investing into the markets at this point of time. And that's what we've been doing. I think from here on, the key would be stock picking, and which was not even the case, say, 12 months back, that if you were in a certain segments of the market, you have seen a lot more pain than otherwise, and that would remain the case even from here on. Even within the sectors, you will find winners and losers, and to that extent, going bottom up, doing stock picking would be much more important from here in the markets than just going in and out of the markets.
I have to ask you this, Anish and Anand. I mean, I think on the equity side, right? Those comments in early February, which got so much attention, it came from Naren, lock, stock and barrel out of mid caps and small caps, and it generated such a heat and debate all across. And Anish, you run the small cap fund, right? I mean, you guys have been cautious way before, and I think Naren was making this point for a while as well, that small caps and mid caps are very expensive. I mean, your small cap fund has been closed for subscription for almost a year now, Anish?
Yeah, almost exactly a year. You're right.
So, is the view still very strong, or are on mid and small caps? You said one needs to be cautious here. The preference is clearly large caps. But as Anand also pointed out, stocks have in the small cap space come off very sharply across the board. So, extremely cautious now. I mean, a little cautious, but maybe a little more attractive. What's the sense on small and mid caps?
See, I think the best way to put it is the risk-return trade-off is far more favorable in the large caps than in the small caps. In the small caps, you still have stocks that, if you look at price-to-book values, they're excess of 5, 8, and then you look at the moats of these business, the competitive position of these companies, it's not that great. If you look at the balance sheets, there's a lot of, stuff that you typically don't want, very high inventory levels, very high receivable levels. So there's enough minefields in the small and mid-cap space in our view. I mean, that's not to say that you can't find anything to invest in, but Even in our small cap portfolio, if you look at the published portfolio, we have a fair amount of large caps because we feel that overall they offer a better return trade-off. So to the extent that's regulatory allowed, we have skewed even the small cap portfolio towards large caps and largish mid caps.
Right. Okay. So, I mean, point taken. Manish, as Anish started by saying that there is no structural problem in the economy. Demand, though, is weak, and that needs to be fixed. And I think your view, Manish, also is that it needs help. I mean, the economy doesn't need saving, but it does need help, both on the fiscal side and monetary side as well. So, your thoughts there, Manish?
Right. So, we had a very good run in the economy in the last 2-3 years. Last 6 months has been a period of time where we've seen softening of demand. And, as Anish rightly pointed out, there are no major concerns. There was a period before 2020 when we were going through a balance sheet problem in India. Corporate balance sheet and the financial balance sheet both were under issue, and which is where the economy had a very slow growth for a particularly long period of time. At this juncture, we think that India is still in a mid-cycle. And what we are seeing is a mid-cycle slowdown or mid-cycle correction. And these mid-cycle corrections can typically be addressed if you have the right policy measure. So effectively, RBI has to cut interest rates. And rightly so, we've seen one rate cut, and we'll see more rate cuts till the point that demand in the economy starts to improve. I think additionally, fiscal policy is also important. While, fiscal was very high in 2021-22, the government rightly reduced fiscal deficits, over the next 2 years. But at this juncture, if we, concentrate on fiscal consolidation, the problem is the government revenue any which ways will start coming down because of the slow economic growth. And that will put additional pressure on the fiscal. To maintain the fiscal deficit, the government will have to cut expenditure at a point when the government, where the economy is at the margin slow. So I think government should not focus too much on consolidation at this point of time, allow the fiscal to slip up a little bit, and then allow consolidation when the growth is back. So you will have both fiscal policy and the monetary policy working at the same time. And, the RBI has also kind of, given liquidity back to the market. That should help the banks to allow flow of credit in the economy. So the combination of all of these should allow the economy to gain momentum back again. And that is, the broad view.
Absolutely. We've seen the signs of that easing, both in terms of the regulatory stance as well as rates themselves, Manish, in the last just couple of weeks, right? I mean, latest moves on the priority sector lending definitions and, of course, the rate cut itself. By the way, what is the House view? How many rate cuts this year?
So we expect, 2 more rate cuts from here. And then it will depend on how the economy behaves. The problem with monetary policy is it, works with a lag. So at some point of time, RBI will have to make an estimation in terms of how the forward-looking numbers are, and therefore maneuver policy accordingly. At this juncture, given where, everything is, our expectation is that RBI will cut 2 more rates.
More rate cuts this year. Got that. Anish, so now, given what Manish has just said, I mean, let's apply that to the problem that you had identified. You said that the correction was because of market valuations, not because of any underlying economic issues. So on valuations and the earnings recovery, what are you anticipating? We're ending this year with very sluggish single-digit, nifty EPS growth. FY26, what's the recovery? And then do the valuations start looking far more palatable in that sense?
See, basically, but just to clarify one thing, Surabhi, I said that there was a demand weakness in the economy. I didn't say that there was no economic issue, but I said the only issue was weak demand, and that then reflected in slower earnings growth.
Yes.
Right? So, and we do expect demand revival. So, look, I mean, we do think the Indian economy can grow in real terms at 7-ish%, and add inflation to that. So, it was somewhere in the 11-12% range for nominal GDP growth is not unrealistic. And given that corporate earnings typically, follow that kind of growth, that would be the level we would expect nominal GDP to, corporate earnings also to grow at. See, the point on multiples is, I always say that, look, there's no, science to saying what is the right multiple, right? One can make a case for 21, one can make a case for 19, right? But the reality is if you stay invested for 3 years, even if you entered at 21 and 3 years later the multiple is 19, it's only a 10% spread out over 3 years. So it hurts your returns by 3%. But if you've got good nominal GDP growth, if you've got good earnings growth, you'll still make reasonable returns, right? So the point is, there's no point endlessly debating whether the multiple should be 21 or 19. Reality is it's not outrageously high now, right? That phase is clearly not there. And it could sustain at this level, it could weaken a little bit, but either way it won't change your returns that much over a 3-year period.
Anish, you said earnings growth should be in line with broad GDP growth, but that still means that maybe
it could be a little bit higher. It should be, yeah.
Yeah, so in terms of a rough range number, do you think we're getting back to 15% earnings growth in FY26?
Let's see how quickly the economy regains momentum. As Manish said, right, there are lags between policy being eased and the recovery taking place. So, I think we should be picking up momentum, but whether for that year it ends up at exactly 15 or a little bit lower needs to be seen.
And just to add, even there is global commodities which will play a certain role. So, you really can't independently decide because there will be global commodity prices and movements which will also have an impact on the on a margin, not great, but on a margin on the Nifty earnings growth rate. So
Anish and Manish, we want to get to sectors and themes you like and you would want to bet on as well, although I think you kind of laid out how you think about markets in a broad way. But just one other big variable, Anand, you threw in the word global. Anish, so I want to ask you, Trump tariffs next week, it's the big talking point. But do you believe that it's going to be a disruptor, it's going to be a sideshow? Will it matter in a durable way, or it's going to sort of, pass in a day or two?
No, my view is that tariffs, as far as the overall economy are concerned, are really a sideshow. The economy is broad-based enough that it can withstand some tariffs. So I would make 3 points, right? Firstly, India lowering tariffs is not a bad thing for the economy, right? So even if we chose to lower tariffs, that would be fine. We've lowered tariffs from the 1990s and the economy has done well. So nothing bad happens if you lower tariffs. Second, see the tariff debate. I think trade is one of the most misunderstood economic issues. It's always seen as one country gaining and one country losing. That is not the case. There are winners and losers within the country. And so if the US, for example, decided to impose steel tariffs, all downstream industries which use steel therefore suffer. So you might as well say that the US has made its own manufacturing uncompetitive by putting tariffs. If the US puts tariffs on pharmaceuticals, for example, more than 1/3 of the medicines they consume are supplied by India. There's no other place that can supply at the rates that India does. So what will happen if they put tariffs? The Indian manufacturers are not making supernormal profits. Demand is inelastic. So prices will have to go up. Right? So I think this tariff issue is just being discussed too much. At the overall economy level, I don't think it matters. And the third point, even if there is some reduction in US demand, right, for Indian products, if this domestic demand is strong enough, you can have greater policy support to make sure that the strength of domestic demand offsets the weakness of export demand. So from an overall economic perspective, I don't think tariffs will be the key factor affecting how the economy delivers or the returns that are generated.
Okay. And the point taken, policy support for domestic demand can offset any weakness to demand for Indian goods, right? That's broadly the view. Of course, sectorally, etc., we'll have to see, but more of a sideshow in a broader context, as far as the Indian economy is concerned. Okay, let's just drill it down to sectors and what you like as themes. Anish, one of the big bets for you has been real estate and housing, right? Have you seen, and we've asked company after company on the program, on the channel over the last many weeks, has demand taken a bit of a knock, as wealth effect has taken a hit because of markets falling? What is your own sense? Because, that really has connections with so many other areas and it's so important for the economy as such. Has real estate and housing demand taken a bit of a hit, or does that remain in good state?
So it has softened a little bit, that there's no doubt. So what needs to be seen, right, is that if demand has weakened, the prices in the real estate market should be corrected, or there should be price flexibility downwards so that demand recovers. Actually, if we are sitting here 1 year later, right, or 2 years later, and the economy has not delivered, then the most likely cause of that would be that real estate prices remained stuck at a level where there were no volume of activity, or the volume of activity was subpar. Right? I can't see the economy doing well without good housing activity. At the same time, I can't see the economy doing poorly if housing activity is strong. Even this cycle, right, 3 years back, when you see it picked up only when housing activity started recovering, right? So if there is price flexibility downwards, developers, cut prices to ensure that sales continue happening, and they keep constructing, that would be good enough. The only point I'd make is, I'm not placing a bet. That doesn't mean you should invest in the housing sector or in real estate companies. The point is that is a driver for economic activity across the board. And you can play the cycle in other sectors also, because if housing recovers, other sectors will also do well as a result of the sort of spillover effect. So overall, I'm positive on domestic cyclicals, which includes automobiles, cement, financials selectively, and industrial and capital goods. What we are cautious on is FMCG, and we have been for a while, and IT.
Anish, you mentioned industrial and capital goods. There, the question is that, is one better off in the bigger private sector names, or do PSUs still have a big role in the portfolio? I mean, they've gone through a huge amount of price correction. The orders are still coming in because it's the end of the year. What's your call, PSUs?
So, PSUs across the board, we generally take, at least I take in my funds, a risk management approach. I don't increase the weight beyond a point, and I'm always comfortable with a certain sort of weight managed position in PSUs. And that continues to be the case. I mean, I don't think I've ever skewed the portfolio ever too much towards PSUs. But at the same time, I've never taken the approach that, oh, these are uninvestable and we should not have PSUs. Play it sensibly. When the valuation becomes too much, reduce the position. When the valuation is attractive, very attractive, increase the position. That's always my stance in PSUs.
And on financials, Anish, you said select financials. Can you elaborate on that point? Because it's a very wide basket, from capital market players to insurance, where there's so many deals happening, to obviously the big banks. What is your order of preference there?
So within the lending space, right, I'm going only for deposit-rich financials. I'm still worried about unsecured consumer credit. So I'm avoiding names where there is a lot of exposure to unsecured consumer credit, particularly if the exposure has grown very fast recently, right? So I would like strong deposit franchises, and other financials, I mean, we like basically, particularly insurance, we have an overweight on. See, basically what I'm saying is, if the economic activity recovers, right, both savings and investment pool increases, and there is a greater role for financial intermediation. So financials will do well, provided you avoid areas where there are clear credit risks, or if they are too reliant on, exuberance of capital markets, right? So overall financials should do well. You should avoid areas where there is too much reliance on capital market activity or credit risks.
Fair enough. Anand, what is your view? Domestic cyclicals largely is what Anish has been pointing to. I think you also are bullish on capex and industrials and capital goods and that kind of manufacturing as a theme, etc. as well. Although one difference I can spot, you like IT services. It's a bit of a non-consensus view. Anand?
No, actually that's not correct. We don't have IT services in the portfolio. I think within the manufacturing...
So what do you like, specifically pockets?
Yeah, so again, as I said, this is a nice time to be going bottom up. As I said before, that economy is not broken and it's sort of recovering from a slow growth. And with both RBI and government, some bit of support, the economy should improve. But also there will be enough divergence. So while we will talk about 12-13% sort of earnings growth rate, we will have segments being much better than that, and then there will be segments which will do far inferior. So again, within the manufacturing space, one area where we've been sort of overweight and constructive has been metals. I think that's a little bit of a non-consensus view that we have maintained, given that we believe that China, with its more, higher per capita income, more focus towards, lowering pollution in that part of the world, their competitiveness in general in manufacturing metal should reduce over time. And to that extent, we believe at some point of time the metal prices have to go up, notwithstanding tariff, which is also doing its own role. But that's one area where valuations, we believe, were attractive. And as China recovers or otherwise, we believe the metal prices have to be going up as the costs of producing the same is going up globally, but more precisely in China. So that's one another area that we like.
Okay, all right. That's a great perspective to have on equities. But Manish, we're also rounding up the financial year, and it's been one of those curious years where the Nifty return is about 7.5%. I mean, it almost is looking like fixed income type of returns. Gold has returned 40%. So the question is asset allocation, and looking forward to the next year, FY26, which asset class do you think could steal the thunder? And, also a brief outlook on fixed income itself. And what's the right mix that you would recommend?
Right. So at ICICI Prudential, we always believed in asset allocation. And the reason is that every asset class has a phase where it does very well. And why I say a phase is because there's a lot of behavioral element which get into an asset class. So for example, gold, I mean, we gave a positive call on gold in 22 and 23. And the reason for that was that, one, it has underperformed against a lot of asset classes at that point of time. And secondly, given that uncertainty globally had increased, we thought that gold was a good hedge against, the financial assets. Now, gold has performed, as you said rightly, it has given, outsized returns against other asset classes. Do we see gold as the same hedge as it was 2 years back? I think the answer is no. You need to see the valuation when you look at each of the asset classes. And we believe in mean reversion. So while gold has done exceedingly well in the last 2 years, its ability to give a hedge on the portfolio has reduced meaningfully. I think fixed income looks pretty attractive at this point of time. And the reason we are saying that is, one, we are at a point where, we're seeing a mid-cycle correction. And, we also in the last 3-4 months had a problem of outflows. Now, those outflows also led to tightness of liquidity in, generally the banking system. That led to increase in spreads in the short end of the curve. When I look at, the 1 to 3 year part of the corporate bond market, I see a lot of value over there where, once, some of the liquidity which RBI has provided comes back into the banking system. As we go into the next financial year, the government spends that money. We'll again see that liquidity is easy. RBI is cutting interest rates, and people will then again go back to, protect their reinvestment. And therefore, I think in the very near term, fixed income returns look pretty attractive. Even globally, I think, when I look at US as well, when I look at the prices of equities and bonds, I think bonds have seen volatility over the last 2-3 years. Not that volatility in bonds will not remain, but pricing-wise, US treasuries look much more attractive than US equities. So I'm generally having a feeling that bond pricing globally, which were at 0% before 2020 in a lot of countries, they are now correcting. And as an asset class, bond generally looks much more attractive than a lot of places where, equity was more attractive 4 years, 5 years back.
And that's 1 to 3 year paper, right? That's where you're seeing the maximum amount of, possible excitement within the fixed income market.
Yes. So we generally track an indicator where we look at the spread between corporate bonds and the underlying, interest rate swaps. Now, interest rate swaps are plain vanilla instruments which expect, the amount of interest rate cuts and therefore the overnight rates over that period of time. And we're seeing that the spread is almost the highest in the last, 10 years. So we find that the 1 to 3 year AAA corporate bond space or the AA corporate bond space looks very attractive in the market at this point of time.
Okay, well, clear view on, bonds clearly more attractive, not just here, globally in the US as well. Appreciate your time, gentlemen, here on this special edition of Market Masters. Anish, Manish and Anand, thank you for being with us here. We'll, of course, get an update on these views as we go along and, of course, figure out where the market is headed as well. So interesting next many weeks and months coming up with lots of events lined up. Thank you very much once again. We'll take a quick commercial break here. Programming continues on the other side.
Welcome back. Well, the markets have taken a bit of a leg down. We're down close to around 30, 40 points thereabouts. The Nifty Bank, though, that's the one that's showing some traction. That's up 150 points. The breadth of the market, for starters, is mildly negative. Nothing really to worry about. Towards the end of the year, you expect some of these edgy moves. I think the trend is pretty much intact till we hold this near-term support of around 23,450 odd. Well, let's focus on our next corporate, Engineers India. That's the stock in focus. The company backed 2 orders worth around 750 crore rupees from the Middle East clients. To discuss this and more, how are the order trends and what's the execution outlook? We're joined by Ms. Vartika Shukla, the Chairman and Managing Director of the company. Good morning, Ms. Shukla, and always good to have you on the show. Thanks a lot for joining in. Well, give us a few details. You won this order from the Middle East. What is the total order inflow in this fiscal year so far? What does it take your total order book to? And if you could split it up for us, what's the international ordering as a percentage of your order book?
Sure. Thank you. And it's an absolute delight to be here. I think the orders we received on Monday are the testimony of the fact that we repositioned our business strategy a couple of years ago as to how to create value for ourselves as an organization, not only in the domestic market, but also internationally. So today we have, kind of not overachieve, but I always say that whatever we have as an inflow, we can do better. So we have crossed the 8,000 crore mark as an order inflow in this financial year, and we still have a few days left for this FY. And if we look at the blend of the order inflow that we have this year, we have surpassed 1,000 crore of consultancy services from international market. And this current order, which we received on Monday, is a blend of the PMC services, the project management services for all the, basically the onshore and offshore work in the Middle East, as well as some of the engineering services, which is, again, an outcome of the inflow and the services that we rendered over the last 2 years. This year looks good in terms of completion of some of the mega projects which we undertook a few years ago, and also the acceleration of the projects that we have today in the domestic sector in terms of project management services. Yeah.
All right. So you're sounding pretty confident and you're sounding pretty satisfied as well. So 8,000 crores of order inflow, that's the number that we got in there, and around 1,000 crores of consultancy from international business. We got a couple of numbers from you on that front. What's the total order book right now? The last number that we have is in that vicinity of around 11,000 crores. There would be some execution as well. So give us an updated number. What is the order book? Split it up for us between turnkey as well as consultancy. Please go ahead, Ms. Shukla.
So it's close to 12,000 is our order book today. And it's a very healthy blend of about 48 to 49% of consultancy business, and about, the rest of it, about 50% from the LSTK cost plus OB business. So it's a very healthy blend, and we have positioned ourselves accordingly in terms of the business strategy to get orders in the consultancy segment, in engineering, in the overseas market, which has a turnaround period of about 12 to 14 months, realizing our turnover accordingly, and the mega projects, which take 36 to 42 months for implementation in the domestic sector.
Got it. And out of this total 12,000 crores, we've got the split consultancy as well as turnkey, but international business as a percentage is how much?
So international business in terms of the inflow that we have had this year is about 12% of the total inflow. And within the order book, something like about 20% would be international business for execution.
Okay. Since you mentioned execution, what about execution? towards the end of this year, this fiscal, I think the target was in that vicinity of around 3,200 to around 3,300 crores or thereabouts of revenues. And the street has been looking forward to the execution. So do you end the year in that vicinity? And on that sort of a base, what is the growth you're looking at?
So we are hopeful of ending this year, and the visibility that we have is we will meet the last year's turnover targets with a better margin on the bottom. And you saw the last quarter results, we did about 11% on the bottom line, which is also showcasing the model that we have adopted in terms of execution and also the excellence that we've brought into internal operations by various means. And going forward, the blend that we have today of the oil and gas sector, the infrastructure sector, and the other sectors, also the new age sectors that we have entered, is likely to raise the top line close to about 20% in the next financial year, very comfortably go to about 20 to 25% upward.
All right, so 20 to 25% growth for FY26. That's going to be heartening. And as you said, you've been focusing on improving margins as well. In terms of execution, what is it likely to look like? Because we know consultancy, of their margins are much better than turnkey. So what is likely to be the execution mix? The order mix we have, the order book mix, but execution mix will be what? And what does it mean in terms of EBITDA margins? You gave us the PAT margins, but EBITDA margins, what is it likely to look at? I think the last quarter you did in that vicinity of around 13%. Scope to improve?
Sure, scope to improve. Essentially, it's a blend of both. Today, we work in a more competitive environment, whether we talk of domestic market or international market. And for us to ensure that our value, we create value for our stakeholders, our clients, it is necessary to actually be there to execute those services. So in that, we do strategically position ourselves with respect to our margins, such that we have a healthy order book with a healthy margin. Over the years, we have had huge competition, both domestic and internationally, but our margins will remain as healthy as they were before for the consultancy segment. And on the EBITDA, we expect about 13-14% in the coming quarters because of the nature and blend of the businesses that we have. So I'm very hopeful. Even our margins, which we have won orders for in the LSTK segment, are healthy, and we position ourselves for the value-added kind of projects, wherein we also give to our clients the technical excellence and the competency that we have in our organization.
Okay, all right. What about oil and gas and the diversification away from it? How much will non-oil segment contribute as a percentage of your mix? And there has been a lot of focus out there, right? So how do you see that panning out?
So today, if we see in terms of our order inflow, we have about 52% of order inflow from pure refinery petrochemical, the oil and gas sector, which speaks volumes of the realization of our potential in other areas, not just in terms of the inflow of orders, but the outreach that we have had to position ourselves as a very responsible consultancy firm taking up these orders for execution. So let me put it this way, the other sectors that we have primarily focused are the top layer of the infrastructure, which is about, and of the 8,000 crore plus order inflow that we've had, about 38% is from the infrastructure sector. About the rest of it ranges from the new age technologies, new age areas like hydrogen, gasification, renewables, as well as from the chemical sector. So this is a very good, very sound strategy so far as we go, very well embedded, not just in the functions that we do, but also what the market actually wants from an organization like us.
Final question, ma'am, before we let you go. There's plenty of commentary on whether or not there's a slowdown. Are you observing any kind of slowdown in activity? Is tendering activity as much as you had expected?
Absolutely not. There is no slowdown whatsoever. The testimony lies in the fact that the orders we have secured, and it is almost all the investments that are happening in the country, we are positioning ourselves for execution in all the refinery expansions, petrochemicals, working very hard to get the competitive advantage in pipelines, positioning ourselves well in upstream sector as well. And going forward, there are many projects which are on the anvil in terms of brownfield and greenfield projects, as well as other sectors which are looking at investments in various models. And we are going to be there as a serious player to continue our growth journey in terms of inflow as well as execution.
Okay, all right, Ms. Shukla, heartening to hear that commentary. Thanks a lot for joining in. Wishing you all the best, and we look forward to chatting with you on the show in the coming months as well. For the time being, the two big headlines we have is FY26 guidance, 20-25% revenue growth with margins in the vicinity of around 13 to around 14%. Surbi joins me back in the studio as well. Surbi, markets more or less flattish as we speak?
Quiet, I think. It's a quiet Wednesday morning. Let's see how it picks up. Mid-cap's doing a little better. But I think we've got Mitesh back, so let's get some ideas in on what to do through this day. Mitesh, if you can hear me, what's the call now? Any index trades? Otherwise, what about individual stocks?
So, we have positions both in the Nifty and the Bank Nifty, and what we've done is, get into some call spreads, book the futures, given the fact that we have had a rally and possibly are looking at a pullback. But the bias is on the upside very clearly. As I said, we have bull spreads on the Bank Nifty as well as the Nifty, and intend to add more if I get Nifty, closer to about 23,600 levels, which is where we had a low of 23,614 today. Similarly, on the Bank Nifty, the entry point is still at about 51,550 to about 51,600. So in case we get those levels, we'll add more. So the stance is on the positive side. On the stock side, Nykaa is something, which after a long time has come on the radar. Buy here with a stop just below levels of 169, which is today's low. And look for a target of 180, 182 to begin with. I suspect once we cross those levels, we might even look at higher levels. And SBI Life is the other one, which I would recommend buying with a stop below 1550 for targets of 1620.
Okay. All right, Mitesh, thanks very much. We will connect later in the day for some more tips and ideas. Right now, I have to take a very quick break. On the other side, Manisha Gupta joins in with the latest in the commodity space. Welcome back. We have Manisha in the studios for the latest from the commodity space. And I can see Manisha in a very bright shade of copper color. Yeah, I think it's for the season, right? Copper hitting these all-time highs, right?
It is.
All-time highs.
Yes. It's an amazing market right now because...
Beautiful. Manisha is beautiful in copper color.
All right. While I gloat in what the jacket color is, but let me tell you, the prices of copper also have been surging very strongly. I mean, it's become a very different market, So for the longest time, you would see copper as a barometer for international growth or economic growth therein. But that really seems to be breaking in 2025 right now. So when you look at the US copper prices, we are trading at an all-time high. We've seen prices above $5.22 per pound as well. And with that, we've seen prices gain up by 2.5% in the overnight markets. Copper is up by 14% in last 1 month. And if you look at this year until now, well, the US copper prices have gained up by nearly 31% as well. And the last count I saw, it was still on the higher side there. Well, if you look at the US copper prices, they have actually disconnected from what's happening in the rest of the world. So US copper is trading at a premium of $1,400 a ton to LME right now. And that is happening because the US president has been saying for some time now that after aluminum and cobalt and a few other metals, copper perhaps is the next in the list where you could be looking at 25% import tariff coming in for copper. Now, ahead of that happens, you have seen a lot of copper being flown into US and the buyers are stockpiling it. You are actually looking at a record number of monthly imports coming into the US markets. Usually it was around something around 70,000 tons, but we understand 150 tons and 200,000 tons of copper is being flown into US at this point. The second point that led the copper prices higher was Glencore saying that they are temporarily halting shipments from Chile, and this is due to some furnace issues. And then the markets also are looking at expectations of more Chinese stimulus going forward. It also is about dollar index trading at a 5-month low that has been supportive for many of these commodities. And then the demand that copper really seems to be commanding right now, not just in sense of construction and wires and cables, but also from electrification, from AI and renewable sector is what is telling you that there is a deficit in sense of copper in this year and expectation of the same continuing in 2026 as well, where various banks and brokerages have talked about large deficits in this year. So while we are trading at an all-time highs and while there is a huge disparity, but the street also is throwing a word of caution here. One, the Chinese demand is not so strong at this point in time. The second point is we already have seen an all-time high and you could be looking at some profit taking coming in. And the tariffs, as and when they do come in, that could weigh onto the demand for the rest of the world, barring US there. The weak physical demand is China will continue to weigh onto the markets. And then it also is about markets looking at higher inventories piling up in US. The street will, of course, watch out for the PCE data from US tomorrow and the further direction would come in from that.
Okay, all right. Got it, Manisha. Thank you very much for the latest. Copper hitting all kinds of records overnight. We'll take a break on that note, come back on the other side. It's our special segment, Indianomics. Lata today speaks with Niti Aayog agri-expert Ramesh Chand and Harish Damodaran of the Indian Express on how Trump's tariffs can hurt Indian farmers.